And good morning, everybody. And thank you very much for joining us this morning. Just a little bit about how this today is going to go to make it effective, because you are quite a lot of people here. This is not a typical webinar that you're going to sit and listen to Kevin, Tom, and Indira and Sarah. It's a webinar where you get to engage and interact. And also keep in mind, we sent you the list of all the participants prior to this event. We all know that networking and making connections, it happens after an event. So take the time to get to know the people on this call and maybe set up a one-on-one after this so you can continue to build your network.
Good morning, everybody. Thank you all again for taking your time to be here today. We really appreciate it. I appreciate Marianne going along with my ideas and my panelists here for coming along for the ride as well and being a part of it. I've invited them here because I value their insight. And right now in the commercial real estate space, I think it's really important to find out what's everyone doing so we can best help our clients. I am Sarah Ragusa. I am a commercial real estate and lending attorney at Platzer Swergold Levine, Goldberg, Katz and Jaslow. We're based in Midtown Manhattan. We do a lot of things other than commercial real estate, but that's my baby. So without further ado, let me introduce our panelists. We have Kevin Buparlant from Banco ZK. He is a commercial lender and he is awesome in his space. I'll let him tell you a little bit more about himself. Kevin?
Hey, good morning. Kevin Buparlant with Banco ZK. Commercial bank, work in the Rockefeller office, Rockefeller Plaza office in New York City for the bank. And really we specialize in all types of commercial lending, from small business to commercial real estate, residential investment and construction financing. So here, hopefully it can be helpful and also learn something from everyone today. So looking forward to it.
And we have Indira from Valley National Bank. Indira is kicking ass in her own space. And I wanted to try and get some women lenders on the call because we don't always see too many women lenders. So Indira.
Good morning, everyone. Thank you for joining. My name is Indira Maharaj. I've been with Valley Bank for about 15 months. I've been in the commercial lending space for close to 20 years. I've worked with both commercial banks and mid-sized banks. And we do everything from owner-occupied real estate, investment real estate, construction, lines of credits and loans. And I can't wait to dive into expectations because I think it's so important, especially in the environment that we're in.
Thank you, Indira. And then I'm going to introduce Tom. Tom is an advisor and consultant, a broker. He manages the relationships between the banks and borrowers. So Tom Rayvert from Pathway, let's hear from you.
Good morning. Thanks for having me. I'm Tom Rayvert. I work for Pathway Capital. I work with Glenn Thomas. I spent 35 years in institutional lending, pretty much everything from processing, appraising, underwriting to at one point chief lending officer. So I feel like I have an intimate understanding of managing expectations, and I'm happy to be here. So fire away.
Awesome. So I think one of the more important topics right now in managing expectations is what deals are being made, what are the changes that we're seeing, how are lenders accounting for the risk or trying to mitigate risk, what asset classes are lenders completely staying away from that maybe in the past they were actively lending in, and what are the biggest hurdles that they're seeing right now that they feel they need to sort of put out there so everyone knows, while we may have been doing this before, maybe the circumstances now are such that we need to adjust. So Kevin, let's start with you. Tell me a little bit about the asset classes. Tell me a little bit about what you guys are doing at Banco ZK.
Yeah, some of the some of the asset classes out there right now that you never want to say never, because when a deal's the right deal, it's the right deal. But I think the asset classes right now that are just unless you have a really special connection with the borrower, are going to kind of be a pass from the go. And it's kind of really the obvious, which are the hotels, the restaurants, metro retail, anything where the business depends on people all being together and gathering in one place. But some of the little more obscure that maybe people don't think about, that are going to be tough to get done, and I've encountered them recently, is gyms. Gyms are back and forth whether they're going to be open, not open. Retail malls, strip malls. So even outside suburban areas where you see malls where there might be 10 or 12 tenants, that typically, that they keep them full. There could be issues there. Event facilities, a lot of these event facilities for weddings, bar mitzvahs, all these types of things are really struggling. And also multifamily, specifically in New York City, has been a tough asset class for some banks. So those are the kind of the ones that right away, that I see as some of the more the asset classes that are tougher. And then for everything else, it's really no one's seen final financials for 2019 yet, so no one really knows how this is going to work out. So I think you're going to see a very slow pace with everything right now, where the banks kind of try to hope that they can start to do deals when they start to have year-end financials, either compiled or audited, or tax returns filed, that they can have a little more faith in. So those are kind of the asset classes right now, and kind of what I see for the pace until financials start coming in next year.
Thanks, Kevin. That's insightful. And I want everyone, like, while you're on the call, the purpose of getting us all together is so we can know what's being played, but to bring value to your clients, what deals maybe Kevin can't take right now or isn't looking at, but maybe those are deals that you can take. So connecting with Kevin after this, if he has some opportunities that he could pass on to you, would be a good thing, and vice versa. Anyone in the alternative lending space, these are deals where you're able to provide extra services by connecting with Kevin. We could bring value to our clients in a lot of different ways, even if it's not always by being able to provide the service ourselves. So Indira, same question.
So I'll agree with everything that Kevin said, and I wouldn't repeat it, but I'll just add on some of the things that we're seeing. So we are lending responsibly. We are getting deals done. We have good relationships with customers for long periods of times. We have good relationships with COIs that we trust and we can work with. What I am seeing is less loans without personal guarantees. I'm seeing the bank ask for more reserves than they would typically do. I'm seeing lower loan to values. And we're asking, I know Kevin mentioned that 2019 information is not available, but now the bank is asking that we provide internal statements for 2020 and an update from the borrower on how they manage or how they fared through the COVID and through the lockdown periods. The bank is taking longer to get deals approved. So I think it's really important what I've been doing, and it's helped me to be successful this year throughout the pandemic, is really sitting down with the borrowers and the COIs and the CPAs and the attorneys and helping them to manage their customers' expectations so they can understand why we're taking longer. And New York real estate has changed a lot. Rents are lower, much lower than it's ever been. Businesses are closing, restaurants are closing. So we are being careful, but we're still lending responsibly.
Hey, Sarah, I had a quick question on that topic.
Go right ahead.
Okay, this is Robert, Indira, and Kevin. How are you all factoring? I was previously with Bank of America, but in the current environment, when you have PPP money and COVID stimulus money, even if you get the financials, you're going to have, kind of an artificial numbers there, from the government stimulus. Some of it's going to get converted into a grant, some of it's not. So, how are you modeling that in terms of the analysis of the core value of the enterprise?
So that's, you go ahead, Indra, sorry.
We are taking it into consideration because it will obviously be in the customer's payrolls report. And we are assuming it on the terms that the government gave, which is the 18 months. And we're doing a worst case scenario. And in some instances, we're asking for a reserve, or we're probably doing a lower loan to value. It all depends on the customer and how strong the credit is.
Yeah, totally agree with it, what Indra said. And, just to kind of say the same thing another way, it's all part of the total credit exposure for a client. So we're going to take in particular, if they have the PPP loan with us, we're going to consider that as part of their credit exposure to us, which could change their underwriting guidelines. It could change their financial statement requirements. And it could change the credit approval authorities that need to be involved in such a deal. And I've already seen that happen a couple times. And like Indra said, we're going to stress test it. Let's say that PPP loan isn't forgiven. What's the debt going to look like if we term that PPP loan out over 36 months? And when you amortize a loan over 36 months, even if it's 100,000 or 10,000, it's a drastic change to the business's cash flow. So it doesn't necessarily mean that that's going to be the be all end all on the debt service, but we need to know what it is. And we need to make a prudent decision based upon if things were to not be forgiven. So kind of the same thing Indra said, but yeah, definitely a big factor, and not always disclosed. And we kind of find it out a little bit later, especially on the EDL side, since it's not necessarily that won't be with a bank, it would be with the SBA. So kind of have to dig that up sometimes.
That was a great question, Rob. Thanks for addressing that, and Indira and Kevin for answering. Now let me get to Tom Rayvert. So Tom, you see things, you have the bank experience, the underwriting experience, but now you're having to, manage the expectations of the borrower. So how are you preparing them? What are you doing to sort of guide them through the situation in light of everything Kevin and Indira have?
Yeah, well, I think it starts well before the deal gets to the lender. Clearly when we look at a deal initially, what we refer to as triaging the deal, we size it up, but it's at this point we're setting the expectations going forward. Once we look at the financials and we size up a deal, we assess the borrower's request. What's on your wish list? What exactly are you looking for? I'm looking for a big cash out, high level of leverage, low interest rate on a non-recourse basis. No kidding. We all want that. Right. We had a call yesterday with a borrower who's building a dealership. And he said, "Hey, what do you think? Do you think we can get 4% construction money?" So it was a quick no, but we just give him a reality check. Some of the things that you need to get in order well before it gets to the lender are just making sure that they have their documentation in order, making sure that the key to success is really transparency, thoroughness, and consistency more than anything else. Anyone who sits in an underwriter's seat and they have to bring a loan to committee is going to be under some level of scrutiny. And so the devil's in the details. I think that a broker is doing the borrower and their lending partners a huge disservice if they simply take an income and expense statement and a rent roll and fire it off to not only one lender, but 10 lenders and see who comes back with the best offer. Practically speaking, it's not the way we operate. I was on the receiving end of that. It's not that much fun. It amounts to the broker dumping their work on the lender. So we're very, very careful to go through all the details and what the expectations are in terms of rate, in terms of term, in terms of recourse, just addressing everything so it doesn't it doesn't become an 11th hour, um, uh, let's just call it a speed bump. There's going to be a speed bump in a deal. It's in every single deal. I would say 99% of the time, there's going to be some problem, someone has missed something. We'd prefer to front load the application, front load, really give the lender the application on the silver platter when we can. However, we're not in control. We don't have the financials available. We have access to, sometimes we have access to the borrower's accountant, sometimes we have access to their tax returns. So what we try to do is we try to spend a tremendous amount of time up front so that we clean up all the issues beforehand. Simple things to ask for. Listen, do you have any credit issues that we should know about? Okay. What's the history of the property? I like to hear a borrower talking about his property and essentially brag about it. I want to hear when he purchased the property. What did he buy it for? What kind of improvements? I like to hear that pride. I've seen lenders who basically said, I'm not interested in the borrower's opinion. I'm interested in my opinion. And that doesn't work. I think it's somewhat of a character check for the borrower when you allow them to talk about their own property. But we try to do that as much as possible. On the other side of the equation is managing the lender. We try to give an application that's thorough and complete and fully transparent because we don't want to be retraded. If we're retraded, it's a direct reflection of our contribution to the deal. So this is it gets a little hairy because everyone knows that the borrowers seem to drag their feet. What we don't want to have happen is we go all the way down the line and then we get to final mortgage committee and you hear someone who sits on the board of some bank say, yeah, I'm uncomfortable with this. Well, wait a second here. Uncomfortable? This is what you do for a living. This made it past 3 or 4 checkpoints. And now we're at the 11th hour and the deal blows up or it gets changed dramatically. We'd like to eliminate 99% of that if we could. And it's all about communication as far as I'm concerned.
Thanks, Tom. That's a valid point. I mean, as on the attorney's end, when I'm also sort of in Tom's space where I've represented borrowers and lenders. When we're representing the lenders, I think in this space, any attorney who's active in the commercial real estate world right now is seeing that things are taking longer. And environmental phase ones, bringing it back to, merit, in my experience right now, maybe they're moving at a more reasonable pace now, but when we were in the middle of the pandemic, things were just taking a long time. You couldn't get there, right? You couldn't get site visits. You couldn't get to the site to experience things. So even just the beginning stages of underwriting were taking some time. So managing the expectation that I know you need the money today, I know you need the money yesterday, but things are just taking a little bit longer. Same with respect to title. I mean, Glenn, Matt, Ray, Mike, your municipal searchers, you have to send them to these municipalities that aren't operating at full staff, that aren't operating at the same speed, limited hours. So again, things are taking longer. So while everyone needs the money and we're trying to come together to get the best result for our client, it's not always a smooth transition right now. I think another thing I'd love to hear about from the audience are, what are you seeing in your space? What are you doing? And hold on, before I go to you guys, Tom, you have the opportunity to see right now what the institutional lenders are doing as opposed to what some of the alternative lenders are doing. So I'd like to hear from you. What are you seeing in terms of changes that are being implemented to mitigate risk on the alternative lending side? Because when the banks can't take these, I know that there are alternative lenders going in and scooping them right up. It's a really good opportunity to charge high interest rates. So what are you seeing in that?
Well, what was interesting is very early on, we recognized that there was a natural risk aversion across the board. alternative lenders where this time last year they would have no objection to taking an interest reserve. We're looking for cash flowing deals, at least some level of cash flow, and reserving the shortfall. Now that's going back to, let's call it March through June. Since then, it's lightened up quite a bit. You know, I'm not quite sure whether it has to do with the year-end push and the fact that, you know, maybe people get compensated to get deals over the line by the end of the year, or they have these lenders have money to deploy, but they're willing to take a little bit more risk. We've been assessing which lenders are sensitive to COVID in particular. So for instance, if you're dealing with, there are some lenders who don't want to touch New York at all, New York multifamily whatsoever. It's an uncertain area. They don't really know what the level of collections are. They're just avoiding it altogether. On the other hand, there are other lenders who will basically say, hey, listen, this is temporary. We get it. We want these high quality assets. You still there? We want these high quality assets, and we'll take that risk, but just carefully. We don't see an awful lot of lenders willing to do land loans. We don't see, you know, obviously hospitality and retail. Everyone's gun shy in that area. But if it's industrial, is booming. I mean, it's really incredible. Everyone wants an industrial deal. And there's not, I wouldn't say there's plenty of that to go around, but we have our fair share.
Thank you, Tom. All right, so now I want to open it up to our attendees. Questions. Anyone have any questions for the lenders, or want to share in particular what you're doing in your space or what you're seeing differently in your own space, how you're adjusting?
There's also a couple of people that joined late, so if they want to make an introduction.
Oh, sure. That was Gil, Matt. You want to start, Gil?
Yeah, sure. Good morning, everybody. Very informative group. So my name is Gil Torres. I'm with Restructuring Solutions Group, and we're a debt advisory organization working with middle market companies that are typically in some form of financial distress. My question to the bank, to the lenders here is, where do you see your portfolio in 5 or 6 months? We all have to assume that there'll be a stimulus package coming out somewhere in December or January. And we know that the Fed is talking to the banks about playing nice with their customers and not pushing the buttons too quickly when things turn sour. But where do you see, once that goes away, and eventually it will, where do you see your portfolios, in 5 or 6 months?
Hey, Gil, that's a great question, and good to see you. A long time.
Likewise.
Every bank's going to tell you everything. Their portfolios are great. I think the first stimulus we got in the PPP was really helpful in carrying people for a little while. And the deferments that the banks were allowed to give were very helpful. But, eventually the banks can't keep deferring. The regulators don't like that. And they start to question your balance sheets and your loan loss reserves. And so the banks are going to play nice because the last thing they want to do is sell a bunch of real estate or collect on a bunch of business assets and have a yard sale. So, they're going to play as nice as they can. But I think the best thing I tell borrowers is you got to play nice back. So communicate. When the bank asks you for your financials, just send them the financials. If they ask you for your annual personal financial statement, even if it hasn't changed, send them a new personal financial statement. Communicate with them. If you think there's going to be issues, call them right away and talk to them about it. The nicer you play with your lender and your bank, the more likely they are to kind of figure out ways to work with you, and vice versa. The person who doesn't call their lender back, who doesn't help them clear, what they might think are minor exceptions in their portfolio reports, sometimes that becomes out of the lender's control. And now you're talking about, a loan review team that's, questioning a loan and the lenders basically lost complete control because of lack of communication. So I think the best thing that people can do to help themselves on that side is just be communicative. And if you're an advisor to those lenders, to these borrowers, which a lot of you are, that's the biggest thing I would say to help through the tougher times is just communicate and things like that. But I think time will tell. And I think if a new stimulus comes, that would be very helpful, obviously. But it's really going to start to see the effects at this point now that all that other money from the spring is, most likely run out.
Indira, do you have anything to add to that? Thanks, Kevin.
No, that was perfect. I mean, it's really, really important to communicate, I guess, keeping that open dialogue with your relationship manager, with the banks that you work with, and giving them the information that they need so they could better work with you if you are in trouble. So far, we have been doing well. Nobody knows what the next 6 to 12 months is going to bring. It's very uncertain times. I do hope that we do get a second stimulus. But in the meantime, I know we're doing as much as we can to work with our customers to help them through the process, to educate them on how they could navigate through these difficult times, and keeping in contact with them, not just on the customer's part, but it's also the responsibility of the bank to make sure that they reach out to customers and give them the options and work with them.
Thanks for that, Indira. I wanted to, being that we were talking about the audits and updating financial statements, I wanted to turn to Resnick. I know you guys are saying that you're in auditing space. Do you guys have anything to contribute to that? What are you seeing as being, in dealing with your clients to be able to produce what they need for their banks? Any challenges, or what are you finding as being required from your clients' lenders?
Sure. Yeah. I mean, there's a lot of issues at hand, and one of the biggest things is going concern issues that we have to face in our financial statements, and you have to show the ability of an entity to continue and to be able to repay its debt on a timely basis and all of its service requirements. So I think there's a lot more communication by the banks. And then one of the other things that we have to do is, in terms of looking at financial debt service coverage ratios, if clients aren't meeting those, we're going to banks early. If you know that you're not meeting them, you want to talk to your bank, see if you can get a waiver, see if they can extend it. But I think, what Indira and Kevin had said, it's all about communication often and early. So even if certain things are happening, the bank, the financial statements, we don't want them to be a surprise when they get issued to a lender. So if there's something that pops up, it's, hey, we've communicated ahead of time and everybody's aware, and it's not something that's, oh my gosh. So we're seeing a lot of that.
I have a lot of hotel clients, and it's been interesting. I work with owners and operators who usually partner with a large fund and like a joint venture relationship. And some of those JV partners are just giving their hotels back to the bank. They're not even trying to work with the lenders, which is interesting. But the ones that are, it seems like the lenders are really working with them. Whether that be extension or, like Blaze was saying, letting some of those debt covenants go for the next year or two. But yeah, I think that communication is key with the lenders. So there are no surprises when the financial statements are issued.
Yes, Sarah.
Yeah.
So I think one of the things is that from my experience in portfolio management working for a bank, is that the typical borrower is clueless on how a 30-day, 60-day, 90-day late affects the bank and affects the bank's financials. And sometimes it requires an explanation that, well, you do understand that that the bank has to reserve based on your timeliness of your particular loan. Multiply that by the number of loans in the portfolio that are 30, 60, or 90 days, or God forbid, 120. And it amounts to the bank having to be even more conservative and lend even less. So it's circular. It comes right back. In many cases, we advise our clients. We did this early on, as a matter of fact, to, number one, communicate with your tenants. If tenants out of work, you need to communicate with them, work with them, keep them in there, keep them paying if you can, communicate with your bank. And most importantly, I thought it was important that keep a paper trail. So, when you fast forward to the next time you refinance, when your loan matures or whatever it is, you have an explanation and you can provide documentation to support that explanation. Keep it simple. And again, transparency, thoroughness, and consistency does it, 90% of the time.
Yeah, that's a great point, Tom, and thank you for making that. Those financials, 30, 60, 90-day things, they pile up, and the bank kind of loses their mind when they start to get to a certain point. And I see Indra smiling. I know it's like you don't really know it when you only have a couple in your portfolio that might be missing their financials, but as soon as you stack up a nice chunk, some people that you don't want come looking for you, they come looking for you. So yeah, that's super important. And the lender needs to take a little responsibility, obviously, and reach out to the clients. Yeah, that's a huge one. And it's a real simple thing your clients can do to kind of keep the bankers happy and, kind of stay off the radar, as they say.
Toby, you're in the lending space as well. You're with Basis. You're in a variety. I mean, you're dealing with a lot of different asset classes and different type of loan structures. What are you seeing? Is the CMBS market even, very active right now for you? What are you seeing?
No, no CMBS. We've not touched CMBS since March. Even with the bridge product that just started to come back maybe like in the last month or so, and it's been even more difficult to kind of price some of those deals as well, because we are transitioning from LIBOR to SOFR right now. So right now we're really focusing more so on permanent financing with the agencies. I mean, simple fact that the rates are super low, they're still lending. And quite frankly, they take the loans off our books, so we can kind of underwrite these deals and sell them to Freddie and Fannie in like a 2-month period, right? But the only difference though in that space versus a year ago is now the underwriting requirements are a lot tighter than they were before. So for example, we're even collecting like a 12-month principal interest escrow right now on Freddie Mac deals, and an 18-month escrow on Fannie Mae deals. And then in underwriting, the expenses that we underwrite are more conservative than usual, because right now it's not so attractive to really do any cash out deals. It's not a no, but they are limited in the amount of cash out that we do lend to our borrowers. So it's been a catch-22. Yeah, the rates are low, they're fantastic, but you may not be able to get as much proceeds as you as you banked on at the beginning of the loan. So the part about the important part for us right now is to make sure that when we do the initial sizing on a loan and we issue the application, we're almost going to Freddie Mac at the onset before apping a deal, just to make sure they're comfortable with how we're underwriting it, rather than apping a deal and then a month or two goes by, you finally submit it, and then they cut the thing by like 150 or grand or more. Nobody really wants that. No one wants to hear that story. So we're just trying to be as careful as possible. So it's really challenging right now, but we're starting to see volume pick up again. It's been slow. Maybe the last since March has been real slow, but within the last like 3 months, it's really picked up. And I think a lot of that is due to folks just having pending maturities in the start of the new year, and they just have to pull the trigger on something. So it's getting better, but mostly multi right now. New York is a little bit shaky. We have a moratorium on evictions, so we've been really looking at the collections, because we're having properties right now that may be like 95% occupied, but the economic occupancy may be like at 70%. Quite frankly, nobody's paying their rent if they don't have to. But in other states, we're doing some other deals like in Georgia, in parts of of Detroit, Michigan, even California, you're not seeing slowdowns in collections in those places. I don't think they have any moratoriums on evicting tenants and all that, but just New York City just has a higher exposure, I think, to just the restaurant industry. And now we're talking about another stay-at-home order. So I think vacancies right now are probably around maybe like 7%, but officially we're still like around like 5.5%. So I think in the start of the new year, that's when we're really gonna see the other shoe drop, if you will, because you're gonna have folks that have any kind of forbearance is gonna all burn off. You're gonna have the moratorium. I think it's gonna be over maybe in January, right? And then once you really see evictions start to roll, you're gonna see that vacancy number go higher, and collections are gonna suffer a little bit more before they get better. So buckle up.
So hey, it's Matt Weilheimer. Maybe I could just tag on to Toby, just talk about New Jersey a little bit on the multi side. Just absolutely smoking hot. Never seen anything like it in 25 years. You name a deal, it's getting financed, whether it's institutional, whether it's local regional lenders. Collections in New Jersey, probably 97, 98%. It's unbelievable through the pandemic, how it's held up, even in Class A properties. So we're not seeing any distress at all. These deals, there's not enough supply. It is absolutely insatiable appetite for multi in New Jersey and Eastern Pennsylvania.
Hey Matt, sorry to jump in like this, but you talking Class A?
No. I'm talking about B and C. But I said even the collections in Class A are there. The B's and the C's, which is really the primarily multifamily stock of New Jersey. It's been phenomenal, the collections. But I think, and I just to some of the lenders, I just have a few questions. And by the way, the surge for the year-end closings is unbelievable right now because of Joe Biden's CRE platform. There's a lot of concern of multifamily investors on his platform going forward, potentially taking away 1031s, potentially taking away the stepped up basis, and certainly it affects the multifamily generational owners. And I'm seeing the lenders, I'm getting calls from lenders already. I represent a lot of lenders and REOs, and they're looking to sell their loans. So Tom and Kevin and some of the other folks, back in the day when you took the discounts, the reserve, you still had a reserve. What are the regulators, the auditors saying in today's world about giving discounts on loan portfolios?
You got to reserve. I mean, once you've downgraded a credit, that changes your loan loss reserve requirements. So, and to kind of answer everyone's questions, why New Jersey versus New York City is so much different. It has 100% to do with political risk. I mean, the political changes in the way that multifamily is being handled in New York City and New York State versus what's happening in New Jersey is. I can totally understand and would predict that it would be very hot everywhere else surrounding New York City. But you're also right. The other political risk factor is the surge due to what's going to happen with a new administration. So yeah, good place to be for now in that suburban New Jersey multifamily market. But definitely answer, just to answer that first question again. Yeah, when things are downgraded, if it we're all the banks are pretty much running a credit risk rating on their credits, and a lot of it's automated. So when the information and the debt service and all the ratios are plugged in, and it risk rates at a certain number, you got a loan loss reserve at that number. That's what the regulators want to see. They want to see you be consistent with the way you reserve for every deal, and not kind of just hand select what you're reserving and what you're not reserving for subjectively. It needs to be all done by the same criteria.
Tom and Dira, you want to add to that?
No, that was perfect. I mean, you have to be consistent with every customer and treat everyone the same, especially with the regulators. You have to make sure everyone has the same process. And exactly what Kevin says, we're asking for reserves.
Yeah, I think the only comment I have is that, if you go back to the financial crisis, prior to that and during the crisis, the regulators were chomping at the bit to clamp down on the lenders, and after the market stabilized and we really got out of the recession, they started to slow down with some of that aggression, and started to put themselves in a position so they can more justify their role, because there wasn't an awful lot of risk to the banks. I think that now with the COVID crisis, unlike the financial crisis, where they would sit and kind of predict which asset classes would be adversely affected. This is easy to figure out. It's not too difficult. So I think that the regulators are rearing their ugly head again for the banks, and unfortunately, it's something that each one of the lenders has to manage. And the way you manage it is, once again, make sure you're doing your asset reviews. Make sure that you have a paper trail that goes back to the borrower, and you can explain what's going on in any particular asset. I think that was probably the biggest failure when it comes to asset management, is that it could be as simple as, hey, this just requires a memo to the file explaining why we did what we did. And the banks weren't doing that 10 years ago. And they just need to do that now.
Thanks for that, Tom. We have a question in the group chat from Susan. We have a lot of lenders on here, or people who are in the lending space or seeing it. How many people are we seeing still writing LIBOR business? Bank OZK, I got a no. How about you, Indira? That's a no. Basis, where are you, Toby?
Oh, that's a no.
That's a no. Anyone else? Yes, no? Susan, what are you guys doing? Is that a no for you too?
No, we are still doing some, going to prime where we can, but we are still doing LIBOR, both with deals that we're originating and deals that we're buying into. We're in the equipment finance space as well. I should mention, and it's not pervasive, but I heard on the call of people saying we're not doing LIBOR anymore. So what rates are folks using then on the real estate? And is this really on construction where you would see a variable rate?
Yeah, we're using prime for everything right now. We don't have any intentions to switch over to the 10-year or SOFR. I think it's just simpler for us to manage, knowing that we can kind of use prime, and we know it's really not going anywhere, and then just adjust our pricing based off of that. It seems to be working for us, so that's 100% the direction we're in right now.
Indira?
And that's the same for us. Prime is king right now. So that's what we're using. And we're getting away from LIBOR.
How about you, Toby?
Yeah, I mean, it's only been about maybe a month or two now. So we've not actually, we're using SOFR. We've not, I personally have not priced any deals yet, because most of those deals are going to be in the CMBS or bridge space. So I've not priced anything as of late in that any of those programs, but from what I've been kind of seeing, overall, those rates are going to be probably like in the high fives, low sixes.
Well,
thank you.
As adjusted with margins, right?
Correct.
Mm-hmm. Terrific. Thank you.
Okay, anyone else? We have 3 minutes. So any final questions? Anyone that didn't get to introduce themselves, one or the other, feel free to do so now.
I did have a question. What are for the panel? I didn't hear a lot about the office market. What are you seeing in the office market, especially in the mezzanine space for maturing debt? Like, yeah, how are deals getting done, refied, those types of things?
They're kicking the can down the road, actually. That's what we're seeing and waiting. I think we're still 6 months out before, I mean, I know that companies like Chase are announcing that they're not coming back to the office until maybe June of 2021. So I think that they're just going to wait and hold right now. If they can get a deal done, they'll get it done. But there's not a lot of hope, if you would.
Kevin, you have a contribution to that?
I was going to say the same thing, but probably less politically correct. But yeah, kicking the can down the road's, the best way to say it. Not having information and not trusting, maybe not trusting the information that you do have, kind of has, banks kind of waiting and seeing as long as they can.
Yeah, and the same thing on our side. I think all banks are taking the same approach. Let's just wait and see what happens.
I do have a question for the group, Sarah. If it's since we do have a lot of lenders and people really in touch with the market, has anyone seen recently any transactions being done on the insurance side for commercial real estate? If so, how have things changed there? Or if not, where has that market gone?
Anyone?
Well, I do have a comment on insurance. In New York City, you have a number of properties that have their that will occupy like an illegal unit in the basement. I've never over my 12 years of being a lender, I've never seen any requirements to actually include those units as part of the insurance policy. But as of late now, Freddie Mac is asking borrowers to insure illegal units as well. So if you're not buying insurance and the premium, it's a tad higher, and really no insurance company wants to really insure an illegal unit as well. So that's another challenge.
So what I'm really asking is on the lending side. So has anyone seen insurance companies out there still lending? I know CMBS has kind of gone out there, but yeah, I hear what you're saying though, Toby. But are the insurance companies lending? I'm not seeming to run into them like I used to. So I don't know if maybe some of the broker consultant advisors maybe have still see that, or has that gone in a different direction?
I'm with you on that. There's not an awful lot of activity. I'm not quite sure exactly what they're focused on at this point, but we have not seen a lot of activity.
Because they handle a lot of the commercial real estate in the country, and typically are something that even the banks can't compete with on the structure and pricing side. So yeah, maybe something has changed there. I'll have to look into that more.
Well, Prudential is hiring. They are, I'm just saying.
Hi, everyone. I know it's really late. My name is Stephen Kukiris. I'm another CPA, but I'd love to hear from Blaze or Emily about, and also all these banks on the line. Aren't we going to have issues issuing financial statements if these banks are kicking these deals down the road for less than a year? Are you guys going to be able to issue clean opinions and financial statements to all these lenders for 12/31/20? I'd be curious to hear your thoughts.
Yeah, it'll be interesting. I mean, I think it's a story by story basis. There are certain office deals with medical companies who are doing really well, and there are certain ones where nobody's renewing. And I think you have to evaluate all in all. It's a disclosure, and the banks are aware what the deal is. So even if we didn't disclose a going concern opinion, and I think that's what you're referring to, if we did or did not, everybody knows, that we present historical information. The projection of the future is what everybody is really concerned about. And so I think there will be a lot of going concern opinions this year, but it shouldn't be a surprise to the lender, and it should be a surprise if you don't say anything in the financials about the uncertainty of what's going to happen.
And going back to that, it's very important to be open and honest with the financial institutions. Open and communication is key right now. So be as honest as you can. The bank is not in the business of going into foreclosing. They're in the business to lend. So they don't want customers' real estate. They want to get paid. So it's really important. Be honest with them. When customers have an issue, let them talk to their lenders, let them talk to their banks. And it may work out better that way versus not disclosing any issues that you see in the future or now.
Thanks so much for that. So unfortunately, we're out of time. if anyone has any final comments, we've circulated the contact list. Please feel free to reach out to each other. Don't let this end here. Continue the conversation. For my purposes, here's what I'm looking for. I want everyone to sort of connect and help each other. If you have any borrowers, clients, anyone you know who needs some representation in the commercial real estate lending space, send them to me. I will have, I have this whole network, everyone who's here, plus other people. So they'll be in good hands, and vice versa. Now that I know everyone here exists, I'll keep you guys in mind if down the line we need your services. I hope everyone does the same. Thank you for Marianne for helping put this together. Thank you, Tom, Indira, and Kevin for taking the time, and for all of our participants. I really do appreciate it. Commercial real estate in New York City is not going anywhere. It's going to be here. We've been through downturns. It's been garbage here, and we came back. So it's okay. It's gonna come back. It's not going anywhere. We just need everyone to hold tight.